FIFO stands for First In, First Out. It's a forex trading policy that complies with the regulations set by the National Futures Association, or NFA. As its name implies, under the FIFO policy, a trader is required to close the oldest trades first in the case where there are several open trades on the same pair and of the same size. The rules that apparently apply to the retail trader don't apply to the brokerages when they trade. Maybe this has something to do with the fact that the NFA is actually a self-regulatory body of brokerages. So, if the FIFO rule was in fact equitable and truly intended to help the retail trader, as the supporters of the rule claim, then why would the NFA not subject the brokers that are members of the NFA to the same rule? Is it possible that they understand how advantageous it is to be able to use hedging strategies? We think the answer is pretty clear.
The National Futures Association, NFA Compliance Rule 2/43B, as implemented by the U.S. forex, FX, industry's self-regulatory organization, the NFA, as commonly known as the FIFO Rule, and essentially eliminates hedging. Hedging, as understood by the retail forex trading crowd, is where a trader will have both a long and a short position in a single currency pair at the same time, which is, in and of itself, offsetting. Rule 23/43B prohibits the dealers from allowing this practice by requiring that multiple positions held in the same currency pair be offset on a first-in, first-out FIFO basis. Additionally, it also bans price adjustments to execute customer orders except to resolve a complaint that is in the customer's favor. Also, NFA Compliance Rule 2/43B limits changes to certain straight-through processing transactions. These changes must be reviewed, approved, and documented by the NFA. According to this rule, the investor or trader will first have to close the oldest positions they have opened first when the trader is having multiple orders of the same pair and size. Hence, any brokers regulated by the NFA will have to ensure that they and their traders are complying with this policy. The FIFO rule in Forex ensures that investors do not keep open positions for a currency pair while finalizing other trades for the same currency pair. This ensures that the market is active and remains volatile since the fluctuations are reduced due to open positions. The FIFO rule hopes to reduce the problems caused by open positions so that forex trading is profitable and there is no stalling. It is easier to understand how the FIFO rule will be implemented using an example. A trader wishes to invest in USD/Euro currency pair by scaling. Hence, the trader will go along the three positions at different times and also entry levels. In the position taken first, position 1, the trader purchased Euro/USD Forex futures at 1.3004. The second position, the trader chose 1.3001. And in the third position, the trader purchased at a level of 1.3007. If the Euro/USD level reaches 1.3005, the trader wishes to close the second position since his profit will be more. However, under new rules of NFA and FIFO, this will not be possible. Under the new FIFO rules, the trader will have to sell position 1 first, and the other positions in the same order in which they were purchased. Every investor will have to comply with this new FIFO rule for trading on the Forex. The passage of the NFA Compliance Rule 2/43B saw a mass exodus of trading capital to offshore Forex dealers that still allowed hedging in 2009. While this might be viewed as a boon by the Forex customers that utilize this part of their trading strategies, they run the risk of being more susceptible to fraudulent practices at the brokerage level given that these firms are not held to the same regulatory requirements as their U.S.-based counterparts. How to deal with forex hedging and FIFO. Many people dislike rules under FIFO. If you don't wish to hedge, it's fine. To many people, FIFO rules don't accrue benefits. However, if you know how to deal with the situation under IFO, it will be easier for you. The way to deal with it easily is to use lots of different sizes. In such an instance, if the earlier lot is different in size from the one that comes across later, FIFO rules don't apply. As OANDA or FXM brokers let nano lots, you can use the lots in different sizes without having to come under purview of rules under FIFO. The nano-size lots enable you to mitigate the risk significantly. This is particularly true in the case of small accounts.